Namaskar, hello and welcome friends to Finavision, your one-stop solution for CFA exams. My name is Shushmit Aditya Mukherjee. I'm an educator and an investment research analyst, and this video is a short excerpt from the full class series for CFA Level 3 curriculum. Hope you enjoyed this video. Let's get started.
Framework for developing capital market expectation. So there are 7 steps through which you can set up a framework for developing capital market expectation. Now step 1 is specifying the set of expectations and the time horizons in which those expectations are going to be fulfilled. We'll get into the details and take examples. Just let us take the points first. The first is specify the expectations and the time horizons. So let's say you are thinking that a certain stock is going to rise 20% in next 3 months. This is the first step, setting the expectation and the time horizon. Let's take an example. Let's say there is a portfolio manager who is trying to make a prediction or an expectation on the stock markets, and right now the stock index is at 1000 points. Now the portfolio manager, based on his or her experience, makes this expectation that in 2 years time this index is going to go up to a point level of 1500 points. That is the expectation or the hypothesis, you can say, of the portfolio manager, right? Now the question is, what is the framework based on which such a conclusion can be validated? This is an initial hypothesis or initial intuition, you can say, about the markets that the portfolio manager has, but to confirm it there can be a framework which can be applied. So this is that framework which we are trying to understand here. So there are steps here. The steps are: the first step, specify the set of expectations and the time horizon. So naturally the portfolio manager thinks that the markets are going to go up by 50% over a time horizon of 2 years. See here, not only the quantitative expectation but also the time horizon is important. 50% in how much time? In 2 years time, right? This is the first step, specify the expectation and also the time horizon in which that expectation can be fulfilled. Now this is a basic hypothesis or basic premise from which the analysis starts. Now we have to validate it, we have to reconfirm it, we have to understand, make deeper interpretations into it and confirm it only when the validations are credible. The validations are credible enough. So for that the remaining steps come. What is the second step? The second step is research historical records. So let's say you are basing this assumption based on the market trends, based on the current market trends, right? So your first data point is market trends, and let's say to reconfirm it you go to the previous market trends of, let's say, the previous 2 years or the previous 3 years or the previous 5 years, and let's say your standpoint is either contrarian or momentum wise. Let's say you are saying that the markets have done very well for the previous 2 years and we do not see any deterioration in the fundamentals, therefore in the next 2 years also the markets will keep going up, and this will be the result, it will be even better. This can be one of your conclusions. The next thing can be, you see that the markets have corrected for the previous 2 years. There has been a deep correction in the markets. Now you see the markets are highly undervalued, and based on that you say that the markets are going to go up 50% in the next 2 years. This can be based on, both these conclusions are possible. Now what makes this possible is not only the stock price trends but also certain other fundamentals, like what is the GDP, what is the current valuation or the P ratio of the markets, let's say the market cap to GDP ratio or the stock exchanges P ratio, then what are the interest rates right now, what is the standpoint of the central banks right now, what is the scenario of the economics, what is the geopolitical scenario. All these factors come into the historical records. Historical records means you go back in timeline and see what kind of geopolitical situations, what kind of interest rate scenarios, what kind of regimes, what kind of P ratios led to what kind of outcomes, and based on that and extrapolating all of that into the pricing factor, you come to a conclusion and validate. Okay, let's say I thought it's going to go up 50%, but it's not going to go up 50%, maybe it's going to go up 70%, or maybe it's going to go up 30% or 20%, whatever that can be the conclusion. So this is the second step. The third step, specify models and information requirements, right? So let's say in the research historical record part, you checked 100 different factors. 100 different factors you checked. And from that, you understood that correlated factors related to your hypothesis are only 25 factors, right? 25 factors are important. Let's say you understood many factors, 100 different factors. Let's say the CPI you understood, the interest rates you understood, the geopolitical scenarios you understood, the regime you understood, the political party who is in rule you understood that, the regulatory factors you understood that, the P ratio you understood that, the GDP ratio you understood that, the GDP to market cap ratio you understood that. Now then, after reanalyzing and revalidating all that, you see that the market cap to GDP ratio and the stock exchange P ratio both are redundant. You have to use only one of them. Another factor can be, let's say, which regime is there nationally is less important and the holistic geopolitical scenario is more important. So based on all these filtrations, you filter out from 100 factors 25 factors. So here comes the information requirement. So specify models and information requirement, right? So information from 100 factors, you filter it down to 25 factors. And based on these 25 factors, you also understand what are the risks and return possibilities, right? Based on these information requirements, you understand what are the risks and what are the return possibilities. Now, the return is the market return and the risk, let's say, is the market risk, right? Now, you want to create a model for equity returns. So let's say you have your risk amount, you have your return amount or expectations here, and you find out, let's say, your beta, and you create a mathematical model with which you will calculate the returns projected. You will calculate the returns projected based on that, right? So all these factors have been reduced into two factors. One is risk and one is return. Then you, let's say, you modify the risk into beta and then calculate the returns. This is basically creating the models, and obviously all these things have to be reasonable. They have to be reasonable. Let me write the word here. You have to have an explanation why each of these factors are important, and you also have to have an explanation that why you are using these numbers the way you are doing it. This is the third step. The next step, determine the best sources for information needs. Determine the best sources for information needs, right? So let's say you have done it from Google search. You have searched Google and you have found out these data. Now you are going much more granular. You want to know the correlations, want to know the actual beta numbers, you want to know the actual return numbers up to the daily basis. Let's say you want to know this daily data of stock markets, right? Now you are looking for high frequency data and data that has least biases. Now, when you are going for historical data, there are certain risks. There are the risks of survivorship bias, there are the risks of smoothing bias, there are a risk of data mining. All these risks happen with data, right? So you need to find out the particular sources which give you the best numbers and the most authentic numbers that are available, right? To make better assumptions or to make better calculations, you need those numbers, right? So that can be acquired from the best sources only. The higher the stakes, the more refined the data source should be. A little social media search or a search engine search may not be enough. You need to find third-party resources, credible, valid resources with good reputation, which can give you the best data without certain kind of biases. So this is determining the best sources for information needs. Okay. Then comes the fifth step. Fifth step is what? Interpret the current environment. So after you have got all this data now, you had made your hypothesis, you had created your model, you know what are the variables that are going to be applied in the model, you know the factors. Now all these factors, we spoke about 25 factors here, right? Now these 25 factors, you look at their current condition. Let's say the interest rate currently is 5%, while the historic average interest rate is 2%. Okay. Now based on this, you can set an expectation that the interest rates are going to go down. This is one kind of current environment understanding that you have. Next thing can be, right now there are high geopolitical tensions, but they are predicted to go down in the next 2 years. They are predicted to or projected to go down in the next 2 years, which can, from this you can actually imply that the business will be better, the trade situation will be better, the oil prices will be in a better condition, there will be less constrictions in import and export. Another example can be, let's say you find that the USD is appreciating a lot. The USD is appreciating a lot, which means imports can get cheaper and exports can get more and more costlier. Which means investing in international markets can be an option. But then you balance it with the factor that other currencies are also depreciating. So if I invest in a country where the currency is depreciating, I'll have to balance it. Let's say I invest in a country where the GDP is 10%, but the currency is depreciating at 5%. This means my net to net growth is 5%, 10 minus 5%, which is 5%. So these kind of current environment understanding you have to make. And the sixth step is provide the expectations and the conclusions. So all these 25 factors that you found very, very significant, you have analyzed that, and based on that, maybe you have gone through your expectations once again and you have modified them, and you have said that 1000 points right now the markets are at 1000 points. It is going to go up to 1350 points, right? So you are saying in the next 2 years, previously you were saying the markets are going to go up 50%, but now you are saying that the markets are only going to go up by 35% in the next 2 years. So you have modified your expectations a little bit. Now, the last and an important point is you monitored your outcomes. So let's say your model is saying that in the next 2 years 35% growth is going to happen. Now you compare that with the actual numbers. Let's say you predicted 35% growth, the markets grew by actually 40%. So there was a deviation here, and you try to analyze what were the events or what were the factors which led to this difference. Which factor led to this difference? You want to calculate that. Maybe they are within these 25 factors. Maybe you miscalculated one of those factors, or maybe you overweighed or underweighed one of those factors, or it can be any other factor that you did not consider. It can be some external factor, factors which are outside these 25 factors. So all these things you have to do. So we will revise the steps once again. First, you specify the set of expectations and time horizon. This is basically creating an hypothesis. Then research the historical records, which means you go through a set of data. Then specify models and information required. So once you have gone through the data, you are able to understand which are the information from them which are important, and based on that you apply a model on them to create your expectation. Then the model is selected and the information required is selected. Now you are going more granular and you want to find out the best sources of getting these data. So you have selected the factors for which the data needs to be collected. Now you find out the best sources to collect those data. So this is the step number 4. Then interpret the current investment environment. So currently, what is the environment? What are the geopolitics? What are the macroeconomics? What are the microeconomics? What are the technological aspects? What are the employment scenarios? All these things you go through once. This is the interpretation of the current investment environment. Then the 6th step, provide the expectations and conclusions. So here your hypothesis can get modified slightly or can remain the same, can improve or can degrade. Both these things can happen. 7th point, once you have made your conclusions, you monitor it and find out the deviations that are happening and try to improve your model. Why the deviations have happened? Did I choose the wrong factors? Did I overweigh the wrong factors? Did I underweigh the right factors? All these things you decide in the 7th step. This is basically improving the model. So this is what we mean by creating a framework for setting up your capital markets expectations. So friends, now we discuss what do we mean by data segmentation or data slicing. Okay. So once you have set your expectations, once you have set out to set your expectations, obviously you have a target asset set in your mind, right? It can be different kinds of assets. It can be one kind of assets with their subclasses. It can be different geographies. It can be one geography, right? It can be preferences of different sorts. Now, we are trying to summarize how the data can be segmented in a very brief way. First, let's say you are looking to slice the data in terms of geographies. Now, what can the classes look like? It can be classes in developed markets, it can be classes in USA, it can be classes in emerging markets, etc., etc. Then, let's say you are looking at asset classes. Let's say you are looking at whether to invest in equity or in bonds or in real assets or in cryptocurrencies or derivatives or whatever. They are different asset classes, right? Now, within the asset classes, let's say you select equities only will be investing in. Then, in them, your preference will be multivarious. For example, you may be preferring value stocks. You may be preferring growth stocks. You may be preferring small caps or micro caps. You may be preferring large caps or mid caps or micro caps or IPOs.
The link to the full class video is given in the description below. Please check that out. Thank you so much friends for being with me till the end of this video. If you enjoyed this video, please like the video and subscribe to the channel for more such classes. Share your feedback in the comment section below and share this video with a friend who may find this helpful. For enrollment to practical application courses, internships and CFA curriculum classes, check the description below. Till then, keep watching Finnovision. See you in the next class.